It's all very well bringing me up here and telling me I have to push all these levers and buttons to control the economy. But I don't know what to press and I don't really understand the whole idea of controlling the economy. I thought the economy was made up of individuals and companies. Don't they all make their own decisions? How can I control them?
You're certainly right that the people that make up households and companies are all their own people. They make their own decisions. You're also right that the economy is simply an aggregation of all these households and firms. What I really want you to do is control the level of economic activity.
But how do I do that? Don't the households and firms decide on how much activity there will be?
Well, that's a good starting point. Households and firms trade with each other, and the amount of trading that they do governs the level of national income. Firms sell products to households, and households sell their labor to firms. The more labor is sold, the more products can be produced and the more income the households have with which to buy those products.
So income flows between the firms and the households. The firms pay the households for their labor, and then the households pay the firms for the goods and services that they buy. And once firms receive income from the households in return for these products, they can pay households for their labor. It sounds as though income just goes round and round between households and firms.
That's exactly what happens.
So how can the level of the national income change over time?
Most usually, it changes as a result of the development of new techniques and products. If a firm finds a way of producing its output more efficiently, output will increase. So labor can be paid more, and households will be able to buy the extra output. That's why national income tends to rise over time. On average, in a country like the UK, national income grows by about 2.5% every year, all down to innovation.
But we don't always have growth, do we? Sometimes the economy goes into recession. How can that happen? Presumably innovations don't get uninvented.
That's a really interesting question. Some people have suggested that slowdowns happen because people like to work harder when their labor is particularly productive, like in the wake of new innovations. When the internet was invented, a lot of people worked hard to exploit its commercial possibilities. Then when the innovations dried up, it's possible that people took their feet off the pedal and worked less hard. So we end up with a slowdown, a kind of downturn of the real business cycle.
So you're telling me that my job is to pull these levers and push these buttons, and by doing all of that it will be possible for me to even out the booms and busts of the economy? That's fine, but the question is, how do I do it?
Well, we've got the income flowing between households and firms, right? If we can artificially create a bit more expenditure on the output of firms, then they'll employ more labor and produce more output because they know they can sell it. Once we've injected the extra spending into the circular flow of income, it will keep on flowing between the firms and households. In fact, it might even grow, thanks to something that economists call the multiplier effect.
What on earth is that?
Suppose the government pays for a new hospital to be built. It spends money directly on the builders and the doctors and the nurses and the managers. But these people all go out and spend their extra income in the local shops, restaurants, sports clubs and so on. So indirectly the extra spending on the hospital benefits workers in the shops and elsewhere too. And eventually the shops will hire more workers, and there will be yet more income generated.
So what you're saying is that a bit of extra government spending can lead to an enormous rise in national income. But I can see two problems with that. If the government is spending more, it has to finance that extra expenditure somehow. Presumably it raises taxes. Doesn't that take some income out of the economy? Doesn't it mean that people have less to spend on companies' output?
But the government doesn't need to raise taxes. It can borrow money on the financial markets. Tax revenue doesn't have to be equal to government spending in each and every period. Sometimes spending can be more than revenue. Other times revenue can be more than spending.
Okay, but there's the second problem too. If raising government spending has such a good effect on national income, why doesn't the government just keep raising its expenditure?
That would be nice. But sooner or later you get to a stage where firms cannot produce more. If they are working at capacity, they can't employ more labor and produce more output. When that happens, they will respond to the extra demand for their output by raising their prices. So there is the danger that too much government spending can lead to inflation.
Can the government use tax policies as well as spending policies to try to control the rate of growth of national income?
For sure it can. Cutting taxes has much the same effect as raising government spending. If you were to cut income tax, for example, households would have more of their income available to spend on the goods and services produced by firms. So cutting taxes is expansionary in just the same way as increasing government expenditure.
But either of these is bad news for the government's own budget, isn't it?
Yes, but you would only want to run a budget deficit when the economy is running slow. During periods of rapid growth, you would want to be paying back that deficit. So, on average, over time, things even out. So long as you have a smart Chancellor of the Exchequer.
I can see a lever over here labelled fiscal policy. I'm guessing that that's the control for taxes and government spending. Is that right?
Yes, that's right. And the button over there is to control monetary policy.
Monetary policy. What's that?
It's all to do with demand and supply in the market for money.
The demand for money? Surely that's infinite. I would like to have as much money as I possibly could.
Would you really? I think you are misunderstanding what I mean by money. I'm talking about money in the form of notes and coins, possibly also including assets that people keep in checking accounts in the bank. But I'm not talking about the total sum of people's wealth. I think you would like to have a lot of wealth, but I suspect you would want a lot of that to be kept in some form other than money, am I right? You would want it to be held as some kind of interest-bearing securities like bonds or equities, or as something that gives you direct utility such as land.
Yes, I suppose that's true. But how can I use this button to control the money market? And what effect does that have on national income?
The button controls monetary policy. Press the button and monetary policy becomes more relaxed. Take your finger off the button and policy becomes tighter.
What does a relaxed or a tight monetary policy mean?
A relaxed monetary policy means low interest rates. When interest rates are low, firms tend to embark on capital projects, things like building new factories, starting new production lines. So the demand rises for building services and investment goods like machinery. At the same time, low interest rates encourage households to take out loans in order to spend more on things like home improvements, a new car, and so on. All of these things lead to more spending in the economy, and so also to an expansion of national income. A tight monetary policy means the opposite.
But how do the authorities control interest rates? I thought they were set by the high street banks.
And so they are. But the high street banks will borrow money from the Bank of England on a regular basis. The interest rate charged by the Bank of England influences the interest rates that all the high street banks offer their customers. So the Bank of England can influence a lot of what goes on in the money market simply by changing its own interest rate.
Right. So you're telling me that a low interest rate stimulates economic growth. But right now we have very low interest rates and there is still a need to encourage further growth in the economy. Is there anything more we can do?
That's a tough question. The budget deficit is as large as it has ever been in peacetime. That means there are limits to how expansionary we can make fiscal policy. And there isn't much scope for traditional monetary policy either, because interest rates are so close to zero. But there is another type of monetary policy that can be used.
I think I might have heard about that. Is it what people call quantitative easing?
Yes, that's right. Quantitative easing is all about the Bank of England putting more money into the economy. They do it by buying securities from the commercial banks. In effect, they give the banks more money in exchange for these securities, and that increases the amount of money the banks have to lend out to their customers. So that's another way that monetary policy can stimulate spending in the economy.
I can see why that's all the rage. So I can control everything just by using this button. I have a lever for fiscal policy and a button for monetary policy. All right. I'm ready to go. Countdown to the relaunch of the British economy. 10, 9, 8.
Oh my God. Help us, please, help us.